Perfect. I need to doing its thing where I'm taller. It just depends how I stand. Sometimes, sometimes I like down there and not. I think it's just depends how I'm feeling in the day.
Yes, I think we have someone in now,
Yeah.
Candice.
Hello.
Hi, Candice.
Okay, I'm just moving this up.
Hi,
Hi, thank you for joining us.
thanks for having
Hi
me.
there.
We will be starting shortly. Mary, can you still see the slides?
I can see the slides. I can see you.
Okay, fab,
I
fab,
can see
fab.
me.
Fab, fab, fantastic.
All good.
All good. So we'll give it 1 minute and we start. Hi, for me.
Hi, Tosi.
Hi, thank you for joining us.
It's okay.
So we should start. We'll give it 1 more minute and then we'll get started. And then people will just join us as we go.
Yeah, that's all good. It's being recorded, so it's
Yeah.
great.
You can see Esther has joined. Hi, Esther. Thank you for joining.
Hi there.
Hi, good evening. I'm just commuting from home.
Okay.
Commuting to home, sorry.
No worries. Okay, shall we get started? Yes?
Let's do it.
Naomi? Yeah, should we do it?
Yeah, let's do it.
Yeah, so
Let's
it's
set a 40-minute timer.
Okay. Hi, Maliha. And hi, Mayowa. Okay, so we'll get started. So hi, everyone. Thank you for taking the time to join us today. Really, really good to see you all. I'm very, very excited to introduce our speaker today, Naomi. Naomi is a supporter, a super supporter of Paapo. She was actually our first guest speaker when we started in December last year. And she talked us through getting money ready for 2025. And here we are in November 2025, and 2026 is now peeking through, so it's really great to have her again and to introduce Naomi. Naomi she's an award-winning money strategist with over 20 years experience in financial services, and she is keen on removing the jargon about money, getting people to become more money confident, and also helping people have the financial future they deserve. There's so much more to say about Naomi, but that's a very short recap. So it's really good to have her today. And with the way today will run is that we'll go through all the questions people have sent through to us. Then afterwards, we would now open the floor so you can click on your virtual hand, turn on your camera, or you can pop your questions in the chat. But now I'll hand over to Naomi, who will give us a few words before we dive right in.
Hi everyone, thanks so much for joining this evening, and Tosin, thanks for organising, thanks for asking me. It's just lovely of you, really amazing to be able to support the community. So I thought I'd start just by explaining what a financial planner actually is, and maybe see if it can help spark any questions that you have. I help people get their money working harder for them. Doesn't matter what you earn, what you own. It needs to be working really hard for you because you worked hard to get it there. And that's what I help people do. Now, that could be via investing, via pensions, but it also just helps people plan their financial future. So the way I say it is, think about what you want your future to look like. What are your dreams and aspirations? And I can help make those a reality, because unfortunately, the sad reality is that we need money to make those dreams come true. And also, the way I look at it is, to make sure that people don't run out of money later on, to make sure that everybody can have the standard of living that you've always wanted and that you can enjoy. So hopefully that gives you a bit of an idea of what I do. And I help people with retirement planning, with investing, with pensions, with protection policies, with inheritance tax planning, with later life financial planning, and everything in between as well. So I think that's possibly a good place to crack on, Tosin.
Okay, let's get started.
Thank you.
Yes, thank you very much. So our first question is, for someone who has lost money on trading platforms before, what approach would be best to start investing like a pro?
Okay, so a really great question. I'm obviously sorry to hear that you've lost money on trading platforms, but maybe that is what happens when you are a pro as such. When you trade, trading is also very different to investing. So you talked about, whoever asked this question, you talk about investing like a pro, but also talking about trading platforms. So I think it would be really important to chat to you to find out. If you're on the call, please feel free to pipe in or chuck in the chat anything. But hiya. Hi, Stephanie. Oh, is that a mistake rather than chiming in, or did you ask the question? Okay.
Yes, it is.
Okay, no worries, no worries. So it's all about trying to look at what you're trying to achieve, what you want. So let's look at the two different things. Trading and investing are very, very different areas. Investing is very much about getting your money working harder for you. Exactly what I was saying that I do and help people with. Trading, actually, that's how I trained in my career in financial services, was in trading. Trading is very much about trying to time the markets, trying to make a profit with short-term speculative trades, basically. And they're very, very different. Now, professionals in either of those guises will have a big team and a lot of resources around them. What I would say, if you want to invest, the most important key things is to look at two things. One, the most important thing is the saying, it's all about spending time in the markets and not timing the markets. So timing the markets is trading, and spending time in the markets is investing. So I think the first thing to do is to make sure that you've got time, you give it time. If you're losing money, giving it time, usually it can make that up. And one of the reasons it can make that up is if you don't put all your eggs in one or very few baskets. So I like my analogies. Think about investing, like putting your eggs, your money, your investment funds, over lots and lots of different baskets. If you think about having your eggs in many baskets, then if something happens to one basket, you've got dozens of other baskets to protect all the rest of your eggs. So diversification is absolutely key. That's how the professionals invest. And it's also how professional traders work. You don't have one or two trades, you have a lot. If anyone is looking at trading, I always say, make sure that this is money This isn't money in your pension. This isn't money in investment. This is something that is very much a hobby. Because if you're not a professional, trading would be very much like a hobby, and if you're fine to lose the money, there are courses, there are investment clubs that are very much geared to the trading and the short-term nature of that. But if you're looking at investing, if you're thinking about, if you've got an ISA, a stocks and shares ISA, or even your pension, I would look at putting your money across lots of different baskets. And unless you've got millions of pounds at your disposal, the easiest way to diversify is to invest in different funds. Funds is just a group of investments. If you look at a basket of eggs, lots of eggs in one basket, maybe that basket is a little bit like a fund. So I would look at lots of different funds, spreading it out across all different geographies, all different types of investments. So that could be stocks and shares, that could be bonds, that could be commodities, could be all different areas and different industries. So it could be banking industry, it could be mining industry, or whatever it is that works. So spreading it all across and diversifying and keeping your investment in for as long as possible is absolutely my top tips. And I hope that helps. And if you've got any more questions, obviously, you can always ask me either later in the webinar or just get in touch. Be happy to help.
Thank
That's
you.
it.
Yeah, thank you. I thought that was very comprehensive, so thank you. So the next one is about pensions. We have quite a few on pensions, actually. So this is, what do I do if I have different pensions due to working in different places?
Okay, first of all, this is really, really common. And also lots of questions on pensions. Pensions they feel so complicated because they're so full of jargon. There's so many different rules around them. So I'm not surprised that the majority of questions are going to be around pensions. So I'm really sorry. And I even refer to them as the P word because for so many people, they are just an enigma. But yes, auto enrollment means that whenever we start in a workplace, we tend to have a pension started for us. And I think the average person is in 5 different workplaces over their life, or maybe it's between 5 and 13, but it's a lot. So I know a lot of people can have a lot of pensions. Now, there are some things that you can do, but you also have to be careful because spread out over time, different pensions can have different benefits or different protections around them. So you've got to be really careful if you wanted to move them or do anything with them. So at that sort of area, I would say speak to a professional and see whether it's suitable to put them all in one. But you don't have to put all your pensions in one place. It depends if it overwhelms you and what you'll want to get out of your pensions and everything. First of all, each pension will be invested. Your money should be absolutely safe. So having it in lots of different places doesn't necessarily matter. The reasons why that can be a little bit more complicated is more from your own financial admin point of view. You've got to make sure you keep track of them all. You're probably, let's say you've got 5 different pensions from different places. That's 5 different statements. That's 5 different funds. And it is worth mentioning that if you've got 5 different investments, chances are they're all going to be slightly different. Some may be riskier than the others, which does suggest that maybe they're not all in the right place for you. So it means maybe moving around 5 different pensions into a fund that makes the most sense for you. And that can be really overwhelming for a lot of people. So you can absolutely, a lot of people, each time they go to new employers, they bring their old pension with them and put it in there. I do caution people on that because every pension is different. They may have different costs and charges. And again, you may be losing some guarantees or just some really good benefits or flexibilities that you had previously. So in things like that, look them up, talk to the pension providers, keep meticulous notes so that you know where everything is, and have a look at them. If it's too overwhelming to keep them all together, then just make sure that you speak to any providers that you don't want to keep it with is to ask them, what guarantees, what protections do I have, what benefits are there for me keeping this pension with you versus moving it away? Some have exit charges and all different things, so just make sure that you understand what you've got. A lot of also workplaces provide some financial support, or the pension provider will give you support and answer questions about their pension. So depending on where you're with and who you're with, you may be able to ask, or there are people like me that can absolutely help, and that's kind of what I do every single day, but it's not for everybody. I hope that's helped answer your question, but feel free again to follow up in the chat, pipe up, ask me, you know, if I've not got the gist of it or not answered it to your liking. Thank you.
Okay, so then someone has actually asked a follow-up question. So his question is, does a service/app exist where you can see all your workplace pensions from previous jobs in one place?
Ah, amazing question. Okay, some of you may have read in the papers over the last 5 or so years, probably longer actually, I'd probably say 10 or so years, about something called the Pensions Dashboard. Please do not get too excited. This has been in the works by the government for over 10 years. And we are still, I think, a good 2 years away from a very basic product coming out. But what your question highlights a huge gap out there that is trying to be filled, but not necessarily quick enough or efficiently enough. But at some point, hopefully, you will be able to. The problem is that there are hundreds of pension providers, and a lot of them may not sign up to the dashboard, or it will take time to get everything feeding in. And just a lot of time, a lot of pension providers don't have correct details. So as a financial planner, I've helped people move pensions around, do different things, and I have seen people with old workplace pensions with the wrong names, the wrong dates of birth, the wrong national insurance numbers. So it can become very difficult tracking these things as well. So you can imagine that a dashboard could have its challenges, but hopefully there'll be something in place in a couple of years, and in a few years after that there could be something really quite useful for everybody. There are over £20 billion of lost pensions, so pensions that people aren't claiming. That is worth over £10,000 per person. So to think about it, everybody on this call, there is a possibility that if we look at the law of averages, that there's a pot of £10,000 out there that you didn't know about. Now, obviously, chances are it's not going to be that way. It's probably going to be a lot fewer people, maybe with larger and some with smaller. But having said that, it's really important to make sure you keep track of your pensions. But it's also sometimes very difficult to. A lot of people's previous employers have closed down. A lot of them changed pension providers, and not a lot of them necessarily were very good at keeping us up to date of our pensions. But I hope that answered your question. A great question that's been asked for decades, but maybe soon.
Yes, and I remember that Claire mentioned, I don't know how good she mentioned a platform called gretel.co.uk, so I don't know how good that is. So I've just popped that into the chat as well. So
amazing, yes.
Yes, you could check
Gretel
that.
is good.
Yes.
If you did used to work somewhere and you don't know where your pension was, if you Google pension contact details, there is a government website so that gives you pension contact details. You can go in there and you could just put the name of the company and it will come up with pension contact details, and you can then give them a buzz, write to them, or get in touch. Sometimes it can give you a few, so you may have to make a few phone calls. Sometimes it doesn't have anything on record. So if you had a small employer, it may not be quite as easy. Thanks, Tosin, for putting that in there as well. That's awesome.
Yes, and Malia too has also put
Oh yes, sorry, yes.
Yes, thank you so
Leah,
much,
thank you.
Maria.
That's
Thank
the
you.
one.
Yes.
I use it all the time. If you, and then sometimes I just say to people, if I'm speaking to people and they're trying to track old pensions, I literally go through their CV. So a lot of times I actually have clients sending me their CV so I can see exactly everyone they've worked for, and I use the Find Pension contact details as my first port of call. Other ways is just look at pension providers and see if any of them ring a bell, because I've had some clients that have lost details, but they're like, oh, that name rings a bell, you know, Hargreaves Lansdowne, that name rings a bell, because, you know, obviously you can do that. Speak to old colleagues, speak to previous people you worked with or managed you, or anything at all. So I would definitely recommend that there could be a bit of sleuthing involved, but there's nothing that's as simple. And even for Gretel, you do need to have the details there at hand as such as well. But definitely it's important to try and track them down. So I would definitely be thinking about it, getting in touch with people that you used to work with, used to know people that did, and just saying, oh, just, do you remember the name of the pension provider? And you'll probably find someone will.
Fantastic, fantastic.
Excellent.
So yes, so we still have more on pension. So the next one is, when is it advisable to open a SIP?
Okay, so everyone, SIP, self-invested personal pension. So there's a little bit of a misnomer out there that a SIP, that if it's not a workplace pension, it's a SIP. There are lots of pensions. It doesn't have to be a SIP, to be honest. A personal pension doesn't have to be a SIP. A SIP is very useful, in particular if you wanted to trade around and everything, but maybe a lot of your old workplace pensions, you can still keep them as personal pensions, so you don't necessarily need to open a SIP. But you absolutely can. I would recommend the good times to open a personal pension are if you want a bit more control over your pension contributions. I would always keep your employer pension, but if you don't have advantages in your workplace pension, for example, matching contributions or salary sacrifice, then it may be worth your while thinking about having a personal pension that you can manage yourself, that you can make sure is invested appropriately as well. So some people in particular, if they've got lump sums, so some people, how I work with a lot of people in particular, and where I help them with their pensions, is towards the end of the tax year. If you wanted to reduce yourself into another tax bracket, or if you wanted to put a lump sum in, it's a lot harder for many people to put lump sums in through their workplace pension. So I think that's a good idea. If you don't have a workplace pension, if it's not a good workplace pension, if you run your own business, if you're self-employed, those are all good ideas to open it, to open up a personal pension as well. You can have as many different personal pensions or SIPs as you would like, but then we go back to that second question about having lots of different pensions in lots of different places, and it may become very difficult to keep track of them as well. So I hope it's okay. I've just answered another question
Yes,
with that, because I
yes,
thought it was easier than waiting for that to come up.
yes,
But
yes.
I always think it's good. I know a lot of clients who have a personal pension and a workplace pension, and then what they tend to do is, assuming they've got no protected pensions or pensions with guarantees or with good benefits in them, if they've done that, they tend to, any old workplace pensions they put into their personal pension and use their current workplace pension as a receptacle to make sure that they keep getting those really valuable employer contributions, and potential for contribution matching or even salary sacrifice, but then have something that you've got a bit more control over, and chances are a lot more flexibility with it as well. I hope that answered the person's question as well, but again, always feel free to come up with any follow-ups.
Okay, I think, yeah, that's a very good answer as well. So the next question is, can you explain how state pensions work?
Yes, yes, I can. So a lot of people can get confused between personal pensions, workplace pensions, final salary pensions, and state pensions. They're all different. Really, what the word pension is it's a way of saving for the future. That's really all it is, because a personal pension is just an investment pot. So a SIP or a personal pension is an investment pot of money. It's invested to grow. You can't access it until you're 55, but that number goes up to 57 and is growing over time as well, going up over time. So just to kind of give you a bit of a distinction, now the state provide UK residents or people who have earned and contributed national insurance credits during their working lifetime. They provide a pension, they provide an income in your retirement if you have met certain criteria. Okay, so the main criteria is building up national insurance credits. We pay national insurance. In the old days, it was only for state pension. Nowadays, it's for a little bit more than that as well. But basically, how the state pension currently works is the state pension age is currently 66 and it is rising to 67 next year, to 68 in following years as well. So basically, depending on when you were born will depend on what your state pension age is. Google, what's my state pension age? How, state pension age. There is a government website where you can put your date of birth in, and it will tell you what your state pension age is. So it will be anywhere between 66 and 68, depending on your birth date. That's the first thing, okay? The second thing is when we work and earn over a certain amount of money, when we receive benefits, certain benefits like child benefit, universal credit, carers allowance, we each have a national insurance credit pot. It's all looked after by the government as such. Each of us and our national insurance numbers have a national insurance pot associated with us. Every full year of national insurance credit that goes into this pot goes towards building your state pension. So a full state pension, to qualify for a full state pension, by the time you retire at state pension age, by the time you reach that state pension age, you may have stopped working years before you reach state pension age, or you may be working years after it. So it's obviously dependent on that. But you need 35 years of national insurance contributions currently. I say currently because there is a possibility that will go up. Thank you very much, Taysin, for adding in the link to check your state pension age. I think it's really important that we know, because lots of people don't. But also, these can change, so you want to know how things are impacting you. 35 years of national insurance credits will qualify you for a full state pension. A full state pension right now is £12,014 a year. So we are talking about £1,000 a month. Okay, now to qualify for a state pension at all, you need to have a minimum of 10 years. So if by the time you reach state pension age, you have got 9.5 years of national insurance credits, unfortunately, you get nothing. If you go in to check your state pension, your national insurance state pension, what you qualify for, and that's also another link, which is check your state pension. If you Google that, you can go in there. As long as you've got access by the government gateway, you should be able to find out almost immediately how many years of national insurance credits you've built up. But you can backdate. You can pay to top up your national insurance credits up to 6 years previously. So if you're approaching retirement and you've got 30 years, you may be able to backdate, but it's always good to check every couple of years to make sure that no mistakes are being made and that it's all working in your favour. Now, the state pension is quite valuable, because even if you are building up your national insurance credits, if you move abroad, you will still qualify. If you qualify for a state pension, you can still receive it when you're abroad. If you aren't abroad and you stay in the UK, it will also rise with what's called the triple lock. I don't know if anyone's heard of the triple lock, but the triple lock is something that was introduced not that long ago, and I have a feeling it's not going to be around for that much longer because it's really valuable. If you think about inflation, that's how prices rise. So the triple lock, however, looks at inflation, it looks at wage increases, and it looks at a number of 2.5%. Each year, the government get those three figures for the previous year, and they choose the highest number. They choose the highest percentage rate, and they will increase the state pension by that percentage rate every single year. So during COVID, we saw some double digits percentage increases in state pensions as well. So state pensions are incredibly valuable, but hopefully they don't keep moving the goalposts, because that can happen and has happened in the past with state pensions. But it's provided by the government. Unfortunately, £12,000 a year is not enough to keep people above just a very basic standard of living. So if all you have to your name is the state pension, you may be in for a bit of a shock. So I would definitely check what you've got, because also I looked up on the ONS, the Office for National Statistics, a few years ago, and found out that of the state pension being paid out, only 44% is the full state pension that could have been achievable, which means that more than half of people receiving the state pension do not receive the full state pension. So I would definitely keep track of it. Try and top it up where you can. Be careful not to top it up if you should be on track, if you keep working here. But if you think you may move abroad or anything, it may be worth thinking about investing in filling in some of those gaps. But again, you know, it's worth calling up and speaking to them if you've got some time on your hands to wait for them to answer. Okay.
Perfect. So another thing, another issue is the budget coming up next week. So this question is, how relevant is the budget for our finances?
Okay, another great question, everyone, so thank you. But what I would say is it's both really relevant and it's irrelevant. Okay, so there's two sides to this coin. In terms of relevance, when they come out with the budget next week, 26th of November, I will be glued to the screens. They could change the state pension age. They could change how you qualify for it. Maybe it's not going to be 35 years of national insurance credits. Maybe they'll change something with regards to personal pensions. They did it last year, where pensions no longer were outside of inheritance tax regime. So lots of things absolutely can change. We haven't talked about ISAs, individual savings accounts, which are basically investments or savings accounts that take away all the tax on them. But there's been a lot of speculation that something's going to happen at the budget for that. So there is going to be a significant relevance to people with regards to your finances. But the reason why I think all of that should be taken with a pinch of salt is that we need to manage our finances as best we can and get our money working for us as best we can with the tools that we have available now. We can't speculate or worry about what's going to change tomorrow, next year, or in 10 years. We can only do what we can with what we know today. There are more people that lose by trying to, we were talking, like the first question was all about trading and timing the markets. There are people out there that try to almost game the system and think, oh my goodness, if they're going to change this on a pension, I'm going to take all my money out of my pension. And then they don't, and they're left significantly worse off because they try to do that. So my advice is always, don't be dictated by any of the speculation or anything that the budget does. But if there's something you've been meaning to do, if you've been meaning to open that SIP, if you had been meaning to top up your state pension or check how that's going, if you've been meaning to invest in an ISA or do something, don't delay, do it. Because by the time the budget comes, maybe it'll be too late, maybe that ISA won't be there or whatever. And then remember, things can change. We can't predict the future, but we can do the best with what we have now, and we can absolutely plan for the future with all the information that we've got. So obviously I look at the budget very closely when it happens. I do look at this speculation, but I will never ever advise anyone to act on any of that. Just kind of, you can look at it, you can look, I have a newsletter, but there'll be lots of places that will be analysing it. You can absolutely analyse it if you want to, but really in the end, just look after your finances, make sure you know what you've got, where it is, and that it's working hard for you, and the rest will just take care of itself.
Fantastic, fantastic. So I would like to now open things up a little bit now. So people, if you have questions, this is the time to ask your questions. So, and you can click on your virtual hand, pop it in the chat, or turn on the camera and ask your questions.
Anything at all?
Oh, Stephanie says she sent me some. Oh, sorry,
Oh,
Stephanie.
wonderful.
Oh,
Wonderful.
wow. She has quite a few. I'm sorry, I haven't seen them. Fantastic. So, okay. So the question is, so are there steps I can take to financially protect my children before I get married?
Okay. To
And
financially protect before you get married.
yes, and there's a little bit of a context around it.
Mm-hmm.
I have children which wouldn't be my husband's, and I want them to inherit everything prior to the marriage to protect their financial legacy.
Okay, so that's going to be really important. And actually, there's two factors in this that will play against each other. So if you currently have a will that leaves everything to your children, by the way, a will is really, really important for our finances. I'm not a solicitor, I'm not a will writer, but everything that you work on with your finances can easily be undone if you don't have a properly written will. Anything off the shelf, an online will or anything, may not take into account your own personal circumstances, or may not even be legitimate as such. I'm not saying that it will be illegal, but it may not actually stand up. So I would always recommend that everybody has an up-to-date will and get it regularly reviewed. Most people don't know this, but if you get married, in almost all circumstances, except for one that I'll mention, any wills that either of you have made will be null and void. They will no longer work. So Stephanie, I would recommend that you look to get a will put into place. And the one circumstance where marriage doesn't cancel out a will is if the marriage is mentioned in the will, that this will stay in effect for the marriage as well. So I would speak to a professional will writer or a solicitor to put that into place. And there absolutely are ways that you can mention it in your will, but you can also you can set up trusts, so that what actually happens is that when you die, your spouse can use those assets. So for example, if you ended up purchasing a house together with your new spouse, you don't also want necessarily your spouse to be homeless if obviously the worst should happen and you pass away, and then what would happen is that the spouse could still live in the house, but on their death, the house then goes to the children. So there are different ways to do that, and it doesn't have to be a house. It can also be investments, or you can absolutely just say everything goes to my children. I have a lot of clients, by the way, that have had that situation, and they just each have wills that just go to their own children, and actually just not to each other, but they do make sure that the house is indeed that nobody ends up homeless. But a solicitor or a will writer will be able to help you with that. Does that answer your question, Stephanie? Brilliant. Absolutely awesome. Thank
Yes,
you.
and then in what happens with regards to finances and divorce? So how does parental responsibility impact ISAs and investments for children? How does it work? Does each does each partner have equal rights to know and be kept informed about bank accounts, ISAs, and investments if opened in their names?
So first of all, just to say on divorce, a will is not cancelled on divorce. It's cancelled on marriage, but it's not cancelled on divorce. But the spouse, the ex-spouse, will be totally written out of it, just to kind of keep in with the theme of wills and everything. On divorce, it really depends on the investment that there is there. So if you're thinking about a junior ISA or something, there will be one parent guardian. That's the parent guardian that will be notified of everything going on with the finances for the child. So it becomes very complicated depending on, and highly dependent on, every different family circumstance. So this is the sort of area, I don't want to like keep recommending you go speak to other people, but this is definitely an area where a family solicitor would be able to confirm what rights are dependent on the children's age, depending on the divorce settlement, and depending what accounts have been set up for the child. But there are some really grey areas, and there is something, for example, called a parental settlement rule. If a child receives in their savings account, or if they've got an investment account, if it's not in an ISA, if a child under 18 has a bank account, a savings account, and receives interest of more than £100 a year, it is deemed as being gifted to them by the parent, and therefore the parent will be taxed on that interest. So it really does depend on who the official guardian is, because the children will usually be living with one of the parents, but it will totally depend on how the divorce is structured, how the accounts have been set up for the children. So much more complicated, I'm afraid, on that one. But again, I hope that's helped. But let me know if you've got any more questions, or always happy to ask specialists for you, or get people in contact with someone if that's helpful.
Thank you. That's really good. Any more questions? So I still have a few questions here, but I just wanted to see if anyone had questions that they wanted to ask. Okay, yes, Sophia has one. Okay, so there's another question. This has to do with it's on the issue of divorce again. So if one of the partners is getting money from a house sale and would like to open an educational fund for her daughter, for university, what do you suggest? How do you suggest this should be done? What are your thoughts on that?
Depends on the age of your daughter, and how much you think you'd be looking for, and if you want to save for them. I think there's lots of different questions here. First of all, if your daughter, if your child is not that far off from university, so let's just say if a teenager, because that's less than 5 years away from university, then I would consider a savings account. If they're much younger, and you want to put something in savings, I would consider investments, because you've got much longer, that if there's a market dip or anything, that it could rise back up, and probably take you back to my first question about the importance is diversifying it, but keeping it in the market for some time to give it time to grow, and for any wobbles to be smoothed out on the upside. I would. I've always been of the belief that if you've got a child under 18, there are some investments, so for example, a junior ISA, that whether it's a cash, i.e. savings account junior ISA, or a stocks and shares junior ISA, they won't be able to access it till they're 18, and then they'll be able to fully access it. If this money is yours and it's not like legally the child that you are looking after, I tend to always recommend that people start with an oxygen mask, invest it or save it in an account in your name, and know that that account is for your child, and know that, and it means you can control it. But if something happens, so if something happens and you need to, you need some money, your child's not going to thank you that, oh, I put that in an account for you in your name and I can't touch it, so we're going to have to move house, or we're not going to be able to do this, or you're going to have to change schools, or whatever. So I always recommend that you think, you put your oxygen mask on. Yes, you can put the money aside in their age, and I would recommend, if you're not using your full ISA allowances, open an ISA account in your own name, either cash, savings, or investments, depending on the child's age or when you think they're going to use it. And if you're using your ISA allowance, then even a general investment account, which is basically like an ISA, and you can just feed it into an ISA, the money in each year. If it's more than 20,000, and you can use it, and there may be some tax to pay on it, but again, if it's a larger amount of money, you wouldn't be able to put it all in a junior ISA anyway. And the other thing is, I see lots of families where their children have got a lot of money coming out of their junior ISAs at the age of 18, and then they don't pay for it for university. They are very excited and they'll buy a car, which is actually great. And that's what my daughter has done with her ISA, so with her financial planner mum's approval as well. But depending on what you want it for, you may be like, want it to go to university, want it to go to a property, but they can also pay for ski trips, going abroad, clothes, and just, it can go very quickly because you will not have any control over it. So hopefully that helps, but again, please feel free to follow up with anything. I can see a question from Emma, unless anyone's got anything to follow up on.
Yes. So Emma, besides diversifying my investments, what would you advise I do in terms of S&P 500s? Are they reasonably safe?
Okay, so first of all, for those listening, watching, the S&P 500, that is the US stock market's largest 500 companies. Okay, so S&P stands for Standard & Poor's. They are an index company that calculates who the largest 500 companies are, and then they control it, and then you get a number which is basically the average price. So you can basically buy the largest 500 companies in the S&P. Right. The first thing I actually want to say is the S&P 500 is it's an index, it's a tracker. If you invest in the S&P 500, you are tracking the performance of the S&P 500, hence why it's called an index or a tracker, or however. Indexes tend to be very, very skewed to the largest companies, okay? Which means that indexes are actually not very diversified. I'll give you some examples because the S&P 500 is the perfect example. Globally, let's not think of the S&P 500. Let's think of a world equity index. There's one called the MSCI, World Equity Index. In the world, there are only 11 companies that are above $1 trillion in what we call market capitalization, in size. 9 of those companies are US companies. Now, The S&P 500 is going to be the majority of the S&P 500, or a very, very large percentage, is going to be those 9 companies. So if you think about, even if you're diversifying globally, you are really only going to be owning these 11 companies, and you're basically going to be owning Tesla. I mean, you know, think of all of the Tesla, Apple, Nvidia, all of these companies. You're owning a handful of these US companies, so it's not actually that diversified. So in terms of, are they reasonably safe, it goes back to the fact that less likely, because if you think about, don't put all your eggs in one basket, you've really got them in the top US baskets, and they're quite technology focused, those companies as well. So you could very much find that if one company has a huge fall from grace, that actually your entire pension, your entire investment will significantly suffer. Whereas if you're actually in a much more diversified global funds, you will find, and usually they can come from active management. There are obviously, if you had a lot of variety of different index trackers that wasn't all focused on the US, then you would be more diversified. But I would say be very, very careful of just the S&P 500, because not only are you focused on the larger companies, but you're very obviously US focused. I would be wanting to look globally rather than just US, just equities, and basically just those few companies that we all see in the headlines every day. I hope, Emma, that answers your question. And I would just, you can have the S&P 500, but just make sure it's not a large percentage, and then maybe just start looking at other countries and start adding in other things, and not just equities. Think about other asset classes as well. There are bond index trackers and bond funds as well. They are safer. So it depends on your tolerance for risk, or for those of you that don't quite know what I'm saying, if the markets go up and down and you're on a bumpy ride, how are you with roller coasters? You know, so if you're like, I'm fine with roller coasters, I sit with it, I'm good, then that's absolutely fine. If you like, I like a really nice, comfortable ride, thank you very much, think about adding in other asset classes like bonds, like property, like even some commodities, something a little bit different out there as well. You'll also notice I haven't mentioned cryptocurrency. I do not feel that this is an investment or an asset class. It is a speculative investment. We don't know. It's driven just by supply and demand. There's nothing, you don't own anything there. You literally, depending on how popular it is, depends on that. Unlike these companies that we're talking about, there's no bricks and mortar behind it. So so for me, it's not regulated. So I couldn't advise you on it anyway, but I think it's really only there for people who've got some play money.
We have some more questions, some private questions. So one is,
shall I just quickly answer Emma's follow-on question on the S&P?
Sorry, I haven't seen that.
That's okay.
Sorry.
That's fine. This is why we're a good team here.
Yeah.
Would you therefore say one can have a set amount in the S&P 500 fund and invest also in bonds and other more stable companies? Absolutely. You can have a smaller amount in there. Make sure you diversify across other countries, other companies, bonds, everything. Just yes. Absolutely would say that's a great idea. It's you definitely want to have it in there. What you don't want to do is listen to me and go, I'm not going to have any S&P 500 after I've heard that. But just be careful that some other indices there may be a lot of overlap as well. So if you invest in global equity and you invest in S&P 500, the biggest constituents of each are the same. So there could be a lot of overlap. So do try and break it down and have a look at what you have in total, just to make sure that, again, if there's overlap, you just reduce it again and put something in that there's just not an overlap. Okay, I hope that helps.
Okay, Emma, is that okay? Yes? Okay, so the next one is for those of us that just relocated, where do we start from? Because we're still settling down and don't have the capacity to save just yet.
Okay, that's a really, really good question. Look, obviously, good luck. You've had a lot of change in everything, and you have to focus on where you are right now. I think it's really also a good time, because it's a fresh start, that you can make sure that you manage your finances in a really thoughtful way. One way that I manage my finances, and also savings, but also budgeting, is I have a bank account that has different saving spaces in it. And I don't know if you know what saving space is in, but in quite a lot of different bank accounts, whether that's Monzo, whether that's Starling, and lots of others, where what you can do is you can create online literally little pots, little buckets that you can call whatever. So you could call something rent, you can call it groceries, you can call it whatever you need, clothes. Think about all the things you need. I mean, I've got loads. And what I do when the money comes in, I make sure that I apportion it how I feel that needs to be apportioned. Obviously, only you can tell. If you get X amount per month, you know that you've got rent, food, clothes, heating, utilities, whatever it is, travel, whatever it is that's important to you. Have a different pot for each one, and when the money comes in, you can put it straight into the pot. To be fair, I don't always put into the pot if it's already automatically coming out, because there's no point. If you've got money coming in, you then put money in the pot, then you have to take the money out of the pot to get it taken out. But you can also set up direct debits to come straight out the pots with some of those providers as well. So the first thing I would do is feel very much in control of what you're spending and how that's all working. So, because knowledge is power with that. And in that pot, the most important one is to start thinking about an emergency fund, even if it is £10 a month or £5 a month, or whatever you can. Have something there for emergencies. This isn't saving up for an investment. This isn't saving up for buying a house deposit. This is for when the unexpected happens. The unexpected will happen at some point, and the money will have to come from somewhere, and you would rather it comes from this account, or at least part from this account, than it coming from a credit card or a loan. And particularly if you've just moved here, you may not qualify for a loan or even a credit card. So trying to set up that emergency fund is going to be absolutely key for everything. And then at some point, when you start thinking that your absolute essentials, you're actually okay, you've got enough for the essentials, then you can start adding in pots for other things that you need as well. So I would start with the basics. Don't overthink it about anything. Just kind of live off what you can, and then after that, absolutely start thinking about all these other areas that where you can. And you can start investing, and you can put into a pension as well, very small amounts. You can do that at £10 a month as well. Starting small and building a habit of just a few pounds a month, whatever it is much more powerful than trying to get a lump sum in there, because a habit will build far quicker and be noticed less over time. And one last thing, even if you're starting, a lot of these accounts, like Starling, for example, they have the ability to round up as well. So if you get everything, you can automate everything, so you do not need to do this manually every month. By the way, have everything totally automated, so it does it all for you. I literally every month can see all of my different pots, where they all are, what they all look like, and that's really, really good for those that are, if you have car insurance, or for the big ticket things. It's brilliant, by the way, guys, for Christmas, whether you've just moved or not. Christmas is coming, and we are all going to end up with this big you're buying presents for everybody, you're having people round, you're going out more, you are spending more than you do every other day of the week. If instead of doing that, you put £50 a month aside, I mean, it depends how much you spend on Christmas. Some people may be like, that's not enough, and others are like, what? I just need to do £10 a month. But put some money aside. If you started now, if you started in January, Christmas is going to be a lot nicer. But I was just going to say, round-up accounts, they look at everything you spend, and then they save the difference between what you spend and the nearest pound. So if you buy something for £7.90, it will put 10 pence into a savings pot. If you're spending £7.90 or spending £8, the majority of people will not notice the difference, but they round it up. So yes, Tosin.
Yes, so we still have quite a few questions.
Okay, let's go.
So,
Yep.
yeah, so I just wanted to know that is everybody okay to stay for another five minutes or so? Is that okay? So the questions are coming in now.
They're coming in now, guys.
Yeah, they're
Brilliant.
coming in
Let's
now.
go.
So okay,
Okay.
so I'll first go on with there were some that were sent to me. There's a private chat one. So are there any beginner friendly tips for how I should allocate my investments between a personal pension, cash ISA, and trading account to balance risk and growth? Should I invest in each monthly? Then that's one question. The second question is, because I think you can wrap it all together. The second
Brilliant.
question is, how often should I review my investments or investment strategy? And what factors should trigger those adjustments? Then the final question is, could you please explain the pros and cons of using a personal pension versus cash ISA for my long-term savings goal? So this is one person's questions, but there's still more. There are many more coming up.
Okay.
Yeah.
Okay, let's go. So how to choose between basically a savings account, investing, and a pension. They're all very different. You won't be able to access a pension until later life. So that is good for many, but you need to make sure you won't need that money. So I think it's really important, and and I know this isn't going to be brilliantly helpful, everybody's circumstances are different. So it's going to look very different depending on your circumstances. Now, pensions are for long-term goals because they're invested. Savings is for anything under 5 years. Okay, so if you think this money is going to be used in less than 5 years, then savings, cash ISA, savings account, that's where it goes. If it's going to be more than 5 years, then an investment is good, but less than when you're going to be likely stopping work. And then, of course, stopping work is the long term. I have what's called Naomi's savings and investment pyramid. And it's like think of an Aztec pyramid. At the bottom, you have an emergency fund. Okay, that's the foundations of your finance. That needs to be in an instant access savings account or cash ISA. Then next up, then once you're kind of good with the emergency fund, and you can do all of this at the same time, you don't have to have one and then go to the next. Have an investment. This is your short-term goals within 5 years. Okay, so this could be anything from holidays to it could be renovating the house or something. It could be easy access savings, but it could also be fixed savings, so you could fix it for a year or 2 years. Above that are investments longer than 5 years, and that's stocks and shares, ISAs, investments. Could also be a pension depending on when you need it. And at the top I always put retirement pensions. So think about building your pyramid, think about what you're going to want it for, think about your goals, and then put each one in there. In terms of how to invest, looking at risk is also very, very much about, do you like that safe roll, do you like that safe drive, or are you fine with the roller coasters? So hopefully that definitely answered the first one. What were some of the others? Just
Okay. Yes,
on that, have I missed bits out? I probably
No, I
have.
think you've answered some of them. So you said, how often should I review my investments or investment strategy, and what factors should trigger those adjustments?
Okay, I'd say once a year. Okay, you don't want to be doing it too often because this is all about time in the markets and everything. We just kind of want to leave it there. And what factors, though, There are times when you may want to review it a little bit sooner. Is, for example, if something comes up in the budget, right, and you're like, maybe I should just double check what I've got there. But what you need to be reviewing is, have your circumstances changed? What are you saving this for? When do you need to access it? How risky has it been? How bumpy has it been? How's it gone? How are you feeling about how well it's done? And how long until you're going to need to access it? Because even if you don't want to access something for 10 years, at some point that's going to be 5 years or 4 years, and you want to start reducing the risk and putting it into savings. So hopefully that answers both of those last questions.
Yes, there was, could you please explain the pros and cons of using personal pensions versus cash ISA for my long-term savings goals?
Yeah. Okay. Cash ISA for a long-term savings goal. Okay. Pensions are invested. They will be volatile. Okay. But a cash ISA, if you put your money in there and you need it for the long term, i.e. more than 5 years, the cash ISA is almost certainly guaranteed to lose you money in terms of buying power. If you put £1,000 into a cash ISA today, in 5 years' time, it will buy you less, even with a good interest rate. Over a period of time, interest rates on average are less than the rate of inflation. You will never keep up with it, whereas something like a pension or an investment is your best chance of beating inflation. And that's a fact. I know a lot of people worry about putting money in investments, and there are lots of reasons why not everybody should, or for whatever your goals are, but really an almost certainty is that cash savings will lose money in the long term in real monetary value. So I hope that answers the question, that really for long term you're looking at investing. It doesn't have to be in a pension. It could be a stocks and shares ISA or another investment.
Okay, fabulous.
Okay.
So, yes, Regina has Regina has a question. What's the easiest way to go about your investment, such as junior ISA, bonds, etc.? Do you just look online, and how can you ensure how genuine these investment organizations are? So I think there's an issue of trust here as well.
Yeah, there's always going to be an issue of trust. You need to make sure that they're regulated by the Financial Conduct Authority. Anyone can put that on there. Go with recommendations. Always have a look at Trustpilot, by the way, because you will know. I was when I was online looking for years ago for an Xbox as a reward for my son. He was like, if you do these exams and you do well, we'll get you an Xbox. I remember looking online and seeing it was really cheap in one place, and I looked on Trustpilot and it always had 1 star to say, this isn't legit, you'll pay the money and it doesn't come. It's the same with financial institutions. So you can have a look and see what the real people put, see what the feedback is, and have a look at that. So I think that's the best way to ensure genuine organizations. But as I say, go with referrals. I mean, you've had Hargreaves Lansdown come in here and talk to you. It's a name we all know and trust. There are lots of brilliant platforms. It's not just Hargreaves Lansdown, so you don't just have to use them. But places like Hargreaves Lansdown, Fidelity, you can access junior ISAs, you can access bond investment, you can pretty much do a really good range on there, all in one place, and just get a feel for it. Sometimes you could do a little bit in each, just do a little bit of testers, just to see, do I like their platforms, do I like their customer services, test them out before putting something in regularly or before doing something. See if you like the apps, see if you like them. So I would definitely do your research, ask people. By the way, beginning of November was Talk Money Week, talking about money. Ask people like you've done today, but when you're out and about, do you invest? What platforms do you use? What do you think? Talking about it, it'll be brilliant, really healthy, and you may get some really good nuggets of advice.
Okay, thank you. Regina, does that help? Okay, the next question is from Mayo. It says, rule of thumb question about savings. For a young couple, say 25 years old, outside of your workplace pension savings, what proportion of our income should we be putting away into savings and investments?
I mean, again, I'm so sorry, but it's going to be very specific to your circumstances. So, I mean, there are different rules that say you should be putting, you should be thinking about putting X amount in per month and everything. I'd be careful with that, because also everyone's different. If it's like the rule, if I told you the rule of thumb is that you should be putting away whatever income you want in retirement, if you're starting at the age of 35, let's say, you should be putting away 10% of your income into pensions. That could be debilitating for your finances. That could be absolutely a drop in the ocean and not impact you whatsoever. So I think yes, you can start with the end in mind and go onto a lot of these sites, Hargreaves Lansdown included. You could say, oh, I want to have today's money. It would be great to have £24,000 a year in pension savings. What does the pension pot look like? What do I need to be putting? You can literally work backwards and see, what do I need to be putting money in? But you will find that will change if you've got children, if you've got other dependents or everything. If you've got a big mortgage, this will absolutely change. If you've got disposable income, I would absolutely be looking at putting a percentage extra into your pension, because that's absolutely a great way to do it. That you should be not just spending everything. You've got to look after your future self as well as your current self. But I think everyone's circumstance is different. So I'd be really skeptical of anyone that says, oh, you should be putting this percentage away, because that could really put you guys in financial difficulty. Whereas for others, it's not going to be enough. And they'll actually find that they've undershot, and then whatever it is, you don't want to put yourself in that situation. I know that's not helpful, but there are loads of calculators on all different websites. There's a calculator on my website. You've got lots of calculators. Have a play with different pension ones and just have a look. And whatever you do, build up to it. If you think it's fine, you can just do a little bit here, a little bit there. You can also, if you're really not sure, that's why I'd say stocks and shares ISA as well as your pension, because if you suddenly realize in 5 years' time, oh no, I wish I hadn't have put all of that in, you can access your stocks and shares ISA. Diversify across the types of investments as well as the investments. I think pensions are really important and very, very tax efficient and everything. So don't not invest in a pension, but think about spreading it out as well over investments.
Okay. Fabulous.
Okie dokie.
Okay, so the next question is from Jess. For unmarried people who have children together and have separated badly, clean break, what are the top actions we should be putting in place to protect assets and investments for self and children?
Okay, so if you've already had a break, so first of all, anything that's in a joint account will break up. So there are lots of different things that if you've got money in sole accounts, then you're protecting it. And I guess it depends exactly what you're thinking of. If you've been unmarried and you've had that, are you after that, or is this now? So I'm not quite sure where it's going, but I would say when at any stage, making sure that you've got money in your name, in your and in across all the different investments. If you're unmarried, there's no requirement for that there should be no claims on your investments or your children's. Usually that's another reason why putting money in children's names is not necessarily the best, because you don't get to control it and the child does, and there could be a claim from from the other parent. But this is going to be much more in the remit of a family solicitor. Family solicitors, by the way, or there are lots of There are lots of, it could be mediators or anything, family solicitors, mediators, all of these people, they don't just deal in divorces, in marriage breakups, they deal in lots of different aspects. So I think it will be very dependent on your circumstances, but making sure that everything's in your name, I think is really important. Protecting assets, I think, you know, if you weren't married, and I'm really sorry to hear that there sounds like there's a bad breakup there as well, and I definitely hope everything is resolved. But usually, if it's in your name and you weren't married and it's not in a joint account, then you should be fine. So just making sure that nothing's in joint accounts in that particular case is important. But do seek professional guidance from a family specialist. And good luck.
Okay, so we have one last question. So in regards to making investments, is it better to invest in all, pension, cash, trading, monthly or periodically in one, or alternating on a monthly basis?
Okay, first of all, trading, I wouldn't recommend in there at all. I say investing instead of trading. I think is really important. So in terms of cash savings accounts, investments, investing in investment accounts, i.e. in diversified funds, in pensions as well. There is a significant advantage to monthly contributions, apart from the fact that it builds up a habit. When you look at investments, there is something, it's called pound cost averaging, but it's basically a sneaky way of averaging your investment on the way up, and it smooths out a bumpy ride. So investing little and often is better than lumpy investments. Okay, little and often means that you're averaging how you, and you're smoothing how you enter an investment. So even if investments go up and down, it's a win-win situation for you. If an investment goes up after you've put your monthly contribution in, there is no disputing that that is excellent and really positive. If an investment goes down, that's also positive, because your next monthly contribution is going to be cheaper and you'll be able to buy more for your money. So hopefully that has answered your question. I would be, again, depending on your goals and everything, I would be going across all of them, and better to do a little bit in each per month than making it too lumpy. I hope that helped.
Yes. So thank you,
Brilliant.
everyone. I'm aware that we've really overrun today. I'm sorry about that. And thank you, Naomi, for your patience. Thank you, everyone, for participating today. I hope you've all had a good session. So Naomi is, like I said, she's a super supporter of Paapo. She's in our Paapo WhatsApp community. You can get, after this meeting, I'm going to provide you with her contact details. So if you want to contact her, you can contact her there. And you can also contact her via our WhatsApp community as well. So thank you very much. I just wanted to quickly talk to you about Paapo very, very quickly. So Paapo, we're a social enterprise focused on building financial resilience amongst underserved communities, essentially people like you and me, Black, refugee, migrant and refugee communities. And we provide bite-sized educational content, webinars like this. And we're also launching our collaborative savings app very, very soon. There'll soon be promo videos going on. So look out for that. And then we have our WhatsApp community where we share regularly financial information. So you should join that as well. Now let me get onto that slide if I can. Okay. Yep. Oh gosh, I've gone off again. Sorry. Let me get that up again. Yeah, so you can just scan on the QR code and join the community. It'll be nice to have you on there. So I hope you enjoyed today, and thank you so much, Naomi. You've been so generous with your time. Thank you so much. Really grateful, and thank you to everyone that has joined today. Thank you for spending your evening with us, and hopefully we'll see you all again soon.
Thank you.
Thank you.
Thank you very much.
Thank you
Bye-bye.
so much. Bye.
Thank you.
You're very welcome.
Yeah.
Just wait for everyone to. Yes, I will. Wow. Has everybody, let me see if everybody.
There's still a few left.
Okay, okay. Yeah, thank you, everyone.
We may have had to pop off, so we can always
Yeah, should I pop off? Yeah, okay, let me end it. Yeah, we can rejoin again. Okay.
Okay, I'll see you in a sec.
Okay, see you in a sec. Bye.